Good morning, everyone, and welcome. Today, we'll be diving into the comprehensive auditing of long-living assets in mergers and acquisitions. Our focus will be on how to ensure accurate valuation, maintain compliance, and effectively manage risks throughout audit procedures while adhering to regulatory standards. This is a critical area that can significantly impact the success of any merger or acquisition, and I look forward to exploring these key aspects with you. Auditing long-living assets is essential because these assets play a significant role in financial reporting. Since they are used over many years, their valuation affects depreciation schedules and, ultimately, future income statements. In the context of mergers and acquisitions, conducting a thorough audit of these assets allows us to assess their true value accurately and uncover any hidden liabilities that could affect the deal. This process is crucial for protecting stakeholders, as it verifies that the assets are legitimate and exposes any risks or potential overstated values during the transaction. Furthermore, accurate auditing directly impacts deal pricing, helps ensure legal compliance, and smooths the path for successful integration after the deal closes. Overall, the main goals of auditing in an M&A setting are to establish the real value of assets, identify liabilities and risks, confirm legitimacy, and support compliance and integration efforts. When we talk about long-living assets, there are several key types to consider. First, we have property, plant, and equipment, or PP, which includes land, buildings, and machinery, essentially the physical things a company needs to operate. Next are intangible assets, which are non-physical but still very valuable, like patents, trademarks, copyrights, and goodwill. Then there are natural resources, such as oil reserves or timberland, which are unique because they can be depleted over time. Infrastructure assets include public use facilities like roads and bridges, critical to supporting communities and economies. Leasehold improvements refer to long-term upgrades made to properties the business leases, enhancing their value and utility. Finally, investments in subsidiaries or joint ventures are also considered long-living assets, especially in mergers and acquisitions, since they represent strategic stakes in other companies. Each of these asset types plays a significant role in the long-term stability and growth of an organization. When auditing long-living assets, the first step is to verify their existence and condition. This often involves physical inspections and obtaining confirmations from third parties to ensure the assets are actually there and in good shape. Next, we need to assess the valuation of these assets. This includes looking at their cost basis, checking fair value measurements, and performing impairment tests to see if the asset's value has declined. We also review the depreciation methods being used, along with the estimated useful lives, to make sure they are reasonable and consistently applied. Another important procedure is examining acquisition documents to confirm that capital expenditures are valid and properly recorded. Finally, we test the classification accuracy to ensure assets are correctly categorized between capital assets and expenses, which impacts how they're reported and depreciated. Together, these steps help provide a thorough audit of long-living assets. When we talk about key audit issues during M&A activity, there are several critical areas to focus on. First, valuation and asset verification is essential. This means ensuring that the acquired assets are accurately valued, including intangible assets and goodwill. We also need to make sure that the asset registers are complete and ownership titles are verified. Reviewing any prior impairments and assessing whether current estimates are reasonable is another important step. Next, risk identification and disclosure plays a big role. It's vital to identify and disclose any contingent liabilities related to long-term assets. We have to be alert for risks of asset overstatement, which can artificially inflate the company's value. Fully complying with all disclosure requirements specific to M&A transactions is non-negotiable. Finally, coordination and purchase price considerations are key to a smooth process. The allocation of the purchase price can significantly impact asset values, so careful attention is needed here. It's also important to encourage strong coordination between the buyers and sellers' auditors to ensure consistent and reliable outcomes. Together, these focus areas help maintain the integrity and accuracy of the audit through the complexities of M&A activity. When we look at regulatory and accounting standards, several key frameworks come into play. First, Both IFRS and US GAAP provide comprehensive guidelines for how assets should be recognized, measured, depreciated, impaired, and disclosed. Specific standards like IAS 16, IAS 38, and ASC Topic 360 outline these rules in detail. Moving on, business combination rules under IFRS 3 and ASC Topic 805 are particularly important during mergers and acquisitions, as they dictate how assets are valued in those transactions. Auditing standards also play a crucial role, with ISA 540 focusing on accounting estimates and ISA 500 emphasizing the collection of audit evidence, guiding auditors in their work. Then, we have SEC reporting requirements, which ensure companies maintain transparency when it comes to material impairments and disclosures related to M&A activities. Lastly, the Sarbanes-Oxley Act has strengthened audit controls, improving the accuracy and reliability of asset verification and overall financial reporting, especially for public companies. Together, these standards create a robust framework for consistent and transparent asset accounting and auditing. Here, we see some real-world audit challenges that emerged during mergers and acquisitions. For example, an audit of impaired machinery uncovered a $2 million overvaluation because the useful life assumptions were outdated. In another case, auditors found previously undisclosed contingent environmental liabilities on land that was acquired, which ultimately led to a reduction in the purchase price. To address these challenges, it's crucial to involve auditors early in the due diligence process. This proactive approach allows us to identify potential issues before they become bigger problems. It typically involves combining thorough physical inspections with detailed document reviews, and in cases involving complex intangible assets, bringing in valuation specialists is essential. Lastly, to ensure audits are robust, clear communication between the buyers and sellers' auditors is vital. Detailed testing of depreciation and impairment calculations helps verify accuracy, while maintaining strong audit trails and thorough documentation supports transparency and accountability. Staying up to date with evolving accounting standards and regulations is also key to conducting effective audits in these complex transactions.